If you're an engineering startup in your first year with 2 to 5 developers, you're already sitting on a research and development tax credit clock that's ticking. We helped a space tech company capture over $187,000 doing this the right way. In this video, I'm walking through exactly how I claim my own startup's R&D tax credit in 2026, how I would evaluate it, how I'd run the study, and how I'd set it up to run in the background every single year going forward. This section walks through the 3 things you do first before attaching any tax forms. The first move isn't pulling any tax forms right away. It's not filling out a calculator to see how much you're going to get. It's not even thinking about the credit yet. The first move is understanding the business. What are we actually building and why are we doing it? Because the R&D tax credit isn't a calculation or tax form problem. It's really an alignment issue. The IRS has its own specific definition of what research and development is. It's your job to map the actual work to the definition, not the other way around. You can't do that unless you understand what the team is doing day to day. Step 1, I'd write down the projects we worked on for the year. This is not going to be in tax language. It's going to be in simple, plain English. What were we trying to build? What was so difficult about it? And what did we have that we didn't figure out yet? And what were we trying to experiment on? Step 2, then I take a look at the team. Who's on payroll? Who are we paying as a contractor? And what about maybe qualifying research and development supplies? In addition to that, I also want to know where each person is physically sitting. Now, this matters more than founders realize. A W-2 engineer in the US doing qualified work, you can capture up to 100% of their wages for the R&D credit. Say a contractor doing the exact same work, you're capped at 65%. And anything happening not in the United States, that doesn't qualify at all. So it doesn't matter how technical it is, it needs to be here in the United States. Now, step 3, I'd pull the basic financial data. Think of box 1 W-2s of all the employees. You'd also get employee rosters, maybe some job titles, and the locations for the individuals throughout the year. That's it. So you don't need to reinvent all of your accounting system or the software or the whole processes. You just need to know who got paid what for what kind of work and in what country. Now, if you're sitting on 3 or 4 engineers and they're all US based, maybe they're all on payroll, you've already got a really great foundation. The rest of the work is fitting the puzzle pieces together. And also, before you write yourself off too early to claim the credit, that's actually the worst time to walk away. The payroll tax election that lets pre-profit startups use this credit only applies for the first 5 years of the company. Every year you skip it is a year of payroll taxes you could have been offsetting. All of that is gone forever. Quick aside, before we move on, if you want to walk through your specific situation, there's a snapshot link in the description. Now, typically, pre-revenue founders use it the most, but you're welcome to go ahead and see what your situation is like. Let's keep going. Once you have the foundation, the actual study comes down to 2 things. You have a conversation, and then there's some math. So the conversation is going to be a technical interview of sorts. Book 45 minutes, maybe sometimes an hour, with whoever leads the engineering work. So think founder, CTO, head of product, whoever knows what got built and why they were building it. It's not about asking for the source code or auditing the code base in any way. It was talking about what the team was trying to build, what was the technical uncertainty, and how it was figured out. So that last part matters a lot because that's that 4-part test. So most founders think about research and development and they picture a lab somewhere, a bunch of folks in lab coats with beakers. So that's not what this is. The IRS test asks, what were you building and what were you trying to improve? Was it technical, meaning was it based in computer science, engineering, or hard sciences? Was the answer unknown when you started? And did you have an experimental way to find a solution? For example, if the team has been writing code and maybe they're hitting walls, maybe they're trying different approaches, maybe they're iterating until something works, that's the test. You have all elements of those 4 parts. So innovation only needs to be new to your company. It doesn't need to be new to the whole world. And that's the part that surprises a lot of companies we talk to. Then there's the math. As a rough rule of thumb, in those first few years, the credit tends to land somewhere between 7 to 10% of qualified spend. So for example, if your US engineering payroll is about $1 million and most of that work qualifies, you're looking at roughly $70,000 to $100,000 in credit. Individual situations are going to vary, but that's a good rule of thumb. So what does this look like in real life? So we worked with a space tech company building a hypersonic testing infrastructure, really innovative stuff. They had about 16 engineers, they were pre-revenue, they had about $1.7 million in engineering payroll. They had used 2 automated R&D providers before us. Both providers, they did produce a tax form, but neither of them ever made it onto the actual tax return. Think about that. So that's not because anyone meant for that to happen. It's because the providers didn't coordinate with the company's CPA. They didn't follow up, they didn't confirm the form had gotten filed, and they didn't follow through to take all the steps necessary to claim the payroll offset. Ultimately, did a credit get generated? Sure, on a form, but all the benefit was lost in the end. We stepped in and we helped the team rebuild the study. We coordinated with their tax team directly, and they ended up claiming over $187,000 in federal credits, plus an additional $100,000 in state benefits as well. So that's the difference between just a tax form and a complete claim. So if you want me to look at your specific team and your specific work, that's what the snapshot does. It's a short intake, it's a personalized video back directly from me, and the link is in the description. Now let's talk about year 2 and what happens after the initial claim. This is where most companies make the mistake that costs them more than the credit itself. They treat year 1 as a one-off project. They pull the data, they fill out all the forms, they send them to the CPA, and then they just move on. Year 2 rolls around and no one remembers what the engineering team was actually working on for the last year, and the documentation becomes extremely thin, and then the whole thing becomes a scramble once again at year end. So the right way is to make this a process in the background, like a boring machine that runs year after year. You don't think about boring processes like payroll every single year, do you? No, it just happens. And that's the same logic you should take with the R&D tax credit process. So what does that look like in practice? So maybe you have a 30-minute check-in every quarter with the engineering team. Capture what got built in that quarter, what was technically uncertain, and how it got resolved. You tag it, file it, put it in a folder called R&D tax credit stuff. But why is this important? So the IRS calls this type of documentation contemporaneous documentation. It's records created when the work actually happened. It's not reconstructed 2 years later from memory. So by year end, the study is almost already written and completed. You get the tax forms prepared and coordinate directly with your CPA so that the credit lands on the return, not get lost in a file somewhere. And the cost of not doing this gets expensive fast for early stage companies. The payroll tax offset, that's that election that lets pre-profit startups turn the credit into real cash. That only has a 5-year window. That's a 5-year window when you're growing, you have under 5 million in gross receipts, and that's really when the benefit really matters. If you skip 1 year, you've burned that whole year and you're not able to get that benefit back. You skip year 2, that's another year gone as well. Most founders I talked to didn't realize the clock was ticking until the clock had already expired off of 2 or 3 years. That's extremely unfortunate, but that's just how the rule is written. I had a client who started in the 4th year. They had real qualifying work that was being done over all the last 4 years, and they had 3 years of credits they could have been claiming the whole time and using it to offset payroll taxes. Unfortunately, none of it came back. So once that window closes, it's gone. If you're in year 1 or year 2 and you haven't run a study yet, this is really the time that matters the most. Click the button and run the snapshot in the description to see what your specific window looks like. I'll get back to you in a few days and let you know whether it's too late or not. So if you take one thing from this video, take this. The R&D tax credit is most valuable when it stops being a tax season project and starts running in the background like a boring process. Just quietly, predictably running year over year, saving you money and putting money back into your bottom line. You can build that yourself, and the roadmap I walked through in this video is a real start. And a sharp founder with a good CPA can run it like clockwork. that's a legitimate option for the right team. If you'd rather have a specialist set up alongside your existing CPA and own the process, we are more than happy to help because that's what we do every day. So start with the snapshot in the description and see if it's a good fit for you. Finally, everyone knows that individual tax situations vary from company to company. This is purely educational, not individual tax advice. Work with your own tax professional for your own specific situation. Thanks for watching, and we'll see you in the next one.